To help us analyze all of this, Thomas Hayes, founder of Chairman and Managing Member of Great Hill Capital. Good to see you again. So if I told you that we're going to raise rates 500 basis points and a year later we're sort of in a situation where we are, where inflation does appear to be in check, yet the consumer seems to have no fear, it appears. Are we wrong?
You're right. We're in a Goldilocks economy. Thanks so much for having me on, Phil. I think you've got a situation where money supply, M2 money supply, is still $3 trillion above trend. So the 525 basis points is offsetting that. And then you have people running out of excess savings. So what happens? You would think, oh my goodness, consumer spending is going to go down, except for the fact that more people are going back to work. Labor force participation rate has climbed to 62.8%, which means we have a greater supply of labor, which is starting to give the employers the upper hand on wages and a lid on inflation.
You mean during the pandemic, people essentially quit or worked less, but they still spent. But now that they want to keep their spending at the same level, they decided they're going to go work and, I guess, keep spending, right? So what does that mean for the next 3 months? So what about the worries about school and university, college loans, and the layoffs? I mean, all these things that the bears often talk about. It seems like the consumer just doesn't.
That for 9 months. I remember getting on your show last fall and I was bullish, and everyone was saying the market was going to go down another 20% after it corrected 25%, and here we are up some 30% off the lows. And I think that's going to persist because despite the bears' absolute confidence that earnings were going to drop another 20%, instead they rebounded and they continue to rebound. As you look at 2024 estimates, they've actually climbed in the last couple of weeks from 246 to 248 and change, and I think they're still too low. So as we get closer to earnings season, if I told you, Phil, quarter's earnings reports are going to be up 3.5%, would you be short this market? And the answer is no, and that's exactly what's been happening. Consensus is up 0.5, and for the last few quarters, consensus has been too negative by 300 basis points. They're underestimating the earnings power of these companies. They're underestimating the normalization, and we're seeing it in the results of the stock market and in the results of earnings.
What about Europe? What about China? I think there was some expectation that we'd see Europe perhaps do more, but instead they just raised rates, in fact. We're going to make a decision next week. And then China. I mean, there was high expectations for what they're going to do. I know it's still a work in progress, but for most investors, they wanted more.
Yeah, most investors wanted more. The Chinese government's been putting out trickle stimulus and trickle rate cuts, and they're starting to compound. If you look at the top internet companies, though, since the crackdown in the last quarter, EBITDA was up on average between them about 30%. Revenues were up 7%, and yet you can't find a positive headline anywhere. So I think you just need to give it a little time. They're getting back on their feet. You'll probably see a little bit more stimulus than maybe even the government expects to do right now. They've got to bring down that youth unemployment. But we're actually very constructive on China. We think that's a brand new story that's going to be a tailwind in the coming 6 to 12 months, and Europe quite a bit.
All right, so you are optimistic. Where are we supposed to put our money?
Well, I think, number one, you don't want to forget about China and emerging markets. Look, the fundamentals of these businesses have improved. Like Alibaba, the price has not for the last year. It's been bottoming after the tech crackdown. I think those are going to be positive. But I think also, the ECB is done. So they raised and basically said they're done. The Fed will be next, and that means bonds are going to get bid, which is going to help the balance sheet of banks. No one wants banks. We like Citi, which is kind of the worst of the lot. You saw with the ARM Holdings IPO, the game is back on for IPOs. They're going to start making money on the investment banking side. It's trading at a 60% discount to book, 50% discount to tangible book, 6.8 times next year. Jane Fraser realized her job is not guaranteed, so she started cutting costs this week, and the stock liked it. It's starting. They're getting their efficiency ratio down, and I think it's going to be very constructive moving forward.
I don't think anybody's job is guaranteed. Maybe yours is guaranteed.
I'm my own boss, so. But I work for my clients, so it's up to them.
Look, one serious point. People are saying that the banks have somewhere in the neighborhood of $700–800 billion in these commercial real estate loans. And we all know some of these office buildings, a lot of them, in fact, aren't more than 80% full. Isn't that a concern? I mean, that can't be good. That's why the banks are at these levels.
Well, it's a couple of things. Number one, as rates stop going up and normalize, they'll be able to refinance some of this. They'll be able to raise equity. There will be a lot of extend and pretend that people are thinking that all of these things are a hard stop. The banks don't want the buildings back. They're going to work with the borrowers. The borrowers are going to work with the lenders. We've been through this many times before. And there's a steep distinction. Vornado, people looked at me like I had three heads. The thing was $15. Now it's $25 and people can't get enough of it. Why? Because there's a big difference between A properties, the high-end properties in the good locations that have the new amenities that are luring people back to work, and the B and C properties. It's no different than the mall debacle you saw several years ago. The Simon Property Groups with the Apples and the Lululemons did well. The second-tier malls went out of business, and I think we'll see the same thing with commercial real estate, but we work through the malls and we'll work through the commercial real estate as well.
We may have to have you submit a top 10 list to our producers, I think, next time so we can track everything. Thomas, good to see you.